Hope this video finds you well. Rich Krafcik with Cobblestone Asset Management. I want to share some thoughts with you. I'm finding myself having a conversation fairly frequently right now, and it's happening whether we're talking investments with clients, could be business leaders trying to find some direction in the economy. The reality is 2022 was a tough year, and we're wondering what do we have in store for us ahead. I'm going to share some of the same elements from a recent article I posted, but I'll do it in this video. Try and keep it short. You know I like these charts and I want to share some of it with you. So before I move into some forward-looking thought, let's acknowledge 2022, right? We get to celebrate returns in the good years. We're here and we're available in the down years, and we've talked with many of you. But let's just acknowledge that it was a tough year. I've got the numbers in front of me. We'll put them on the screen for you. S&P 500 was down over 19%. The NASDAQ, which is largely comprised of tech companies, down over 33%. The IFA index, this is international developed markets, it was down over 16%. So we didn't get a lot of relief internationally. And then we put the 20-year Treasury bond in here just to give you a sense of the challenges, because the U.S. government bond is supposed to be some of the safest paper, right? One of the safest places that we can put money. And the 20-year Treasury bond was down over 26%. A lot of that had to do with the dramatic shifts we saw in interest rates over the course of 2022. So with this said, if those are the ingredients and we're building a portfolio with these, the reality is that portfolio, that recipe, it just wasn't going to taste very good in 2022, no matter how we blended those ingredients. So as investors, we all kind of know we're supposed to buy low, sell high. When you think about putting that into practice, sometimes that means adding capital when we don't always feel that good about things. And things, in this case, can mean all elements financial, right? The job market, inflation, stock market returns. How do we feel about things shouldn't always dictate our behavior in real time. And to illustrate that, I want to show you the Consumer Sentiment Index. This tracks consumer sentiment going back to 1971. And notably, if you look at the 8 peaks, so the 8 times that people were feeling the best, and then the 8 troughs, the 8 times that people in general were feeling most pessimistic, something interesting emerges. If you were to buy when people felt the best, the S&P returned 4.1% over the next 12 months. If you buy when sentiment was at its lowest, the S&P returned 24.9%. So a takeaway here, we don't want to wait till we're feeling great to deploy capital, because oftentimes we'll be deploying that money into an environment where we're paying a high price. Sometimes it's worth acknowledging, like sitting here today, sure, we have some unanswered questions in our future. Is there a recession looming? How deep will that be? How will the impact be on corporate earnings? These are questions that we're not going to have the answers to until time unfolds. But investing before all those questions are resolved can oftentimes pay off. So when it comes to sentiment, we saw what appears to be a cyclical low occur between June and July of 2022. And sentiment's increased a little bit since then, but it has a ways to still improve. So let's look at this data from another perspective. And we shared this chart when the bear market first started, but I want to just put it back top of mind for you. We went back and looked at each bear market since the end of World War II. Now, what's a bear market? It's a 20% decline from the peak. That's how it's defined. There's nothing magical that happens at 20% that wasn't really present at 19%, but that's the definition. So we worked with that, and we pulled each occurrence. And you can see the dates on the screen in front of you. And then we said, what was the S&P 500 1 year later, and where was it 2 years later? If this was a roulette wheel paying out even odds on green and red, it'd be fair to say that I hope you'd play the green, the green there, not the red. There's a lot more positive outcomes. In fact, of the 12 previous occurrences, we had 9 instances where the market was positive 1 and 2 years later. As you're looking at those numbers, now let's look into the actual returns a bit more. Of the 3 negatives, one of them was down only 5% 2 years later. Not enjoyable, but certainly tolerable. On the flip side, look at a lot of these growth outcomes. Look at the percentage returns over 1 and 2 years in the green squares. We have some substantial positive outcomes there. So you tie in where we know sentiment is, it's low, with the fact that we're in a bear market, capital being invested today is about 20% below the peak. We have some attractive ingredients, and I think as we mix these ingredients together, the dish may taste a lot better over the next year or two. Now, with that said, that doesn't mean over the next 3 months necessarily or over the next 6 months. I do think we have some economic questions to be answered. We're acknowledging this. You all that are invested with us are likely aware we run a tactical overlay on our models, so we're remaining quite nimble there and we're watching data as it comes in. But I do think in a more intermediate and long-term view, the reality is we have a lot of the right ingredients to put capital to work and to feel really good about these entry points. All right, want to keep it short. If you have any additional questions, reach out to our team. I'm available. We enjoy talking about this stuff and we're here for you. All right, take care.